Hello and welcome to our channel. In this video, we're going to talk about a topic that has been on the minds of many people lately, and that is the possibility of a U.S. housing market crash coming soon. Before we dive into the details, let's first understand what caused the housing market crash in 2008. Back then, the housing market was booming, and many people were investing in properties with the hope of making a profit. However, lenders were offering loans to people who couldn't afford them, and the housing prices were artificially inflated. As a result, when people started defaulting on their loans, the bubble burst, leading to a massive housing market crash. Now, let's fast forward to the present day. There are several warning signs that suggest that the U.S. housing market might be headed toward another crash. First and foremost, housing prices have been on the rise for several years now, and they have reached levels that are not sustainable in the long run. In addition, there has been a shortage of inventory, which has led to bidding wars and inflated prices. Another cause for concern is the fact that many people have been taking out loans with low down payments and high debt-to-income ratios. This is similar to what happened in 2008 when lenders were offering loans to people who couldn't afford them. If people start defaulting on their loans again, it could lead to a housing market crash. The U.S. housing market is currently in a critical period with differing opinions on its future. Over the past few years, the market has experienced significant growth due to record low mortgage rates and high demand, leading to all-time high home prices. However, concerns about a potential market crash have emerged, with experts warning of a possible downturn similar to the 2007 Great Recession, which was caused by faulty mortgages and resulted in foreclosures and empty homes. It's important to note that not all economic downturns affect the real estate market. Despite the 2001 recession, the housing market remained strong. Throughout the past century, the housing market has faced several challenges, but only the Great Depression of 1929 and the Great Recession of 2007 resulted in a significant drop in home values. While the recent pandemic-related housing boom has similarities to the past, most real estate professionals believe that the housing market will not crash and could even aid in the country's recovery. The mortgage industry has taken steps to prevent a repeat of the past, with stricter requirements on borrowers and fewer risky loans. However, mortgage rates have risen, leading to a decrease in home affordability and a potential decline in prices in the near term. Despite this, experts do not anticipate a widespread unemployment crisis like during the Great Recession, and they predict that any recession will be brief. This means fewer homeowners will default on their mortgages, and those who are struggling may sell their homes at a profit. Many homeowners are currently stepping back due to high mortgage rates, resulting in fewer properties selling and lower asking prices. In the event of a recession, mortgage rates are expected to decrease, which could bring back buyers who didn't lose their jobs. This would benefit the economy as a whole by increasing home sales. While the U.S. housing market is experiencing changes in 2023, most professionals do not believe it will crash or trigger a recession, and the housing shortage remains severe. The housing market could even aid in the country's recovery in the event of a recession by increasing home sales. Real estate companies and experts are currently facing challenges in the housing market due to record high inflation and higher interest rates. Predicting the housing market crash for the next 5 years requires an understanding of the factors that cause real estate markets to fall. Housing markets do not suddenly crash, but instead experience pressure over time from multiple variables. A housing bubble arises when home values climb too rapidly and demand and capacity to buy increase. Competition drives up prices when there are not enough houses for sale to match demand. When a housing bubble expands and pressure builds, the market may crash due to interest rate hikes slowing the economy, demand and jobs dropping, and oversupply promoting a buyer's market and cheaper pricing. The severity and speed of the crash depending on how sustainable development was before the slowdown and how serious the causes are. Currently, concerns remain about the housing market as higher rates are holding back both potential sellers and new construction, despite the lack of supply being one of the biggest drivers of home price growth. The United States home prices nationwide, including distressed sales, increased year-over-year by 8.6% in November 2022 compared with November 2021, but home prices declined by 0.2% in November 2022 compared with October 2022. The CoreLogic HPI forecast indicates that home prices will decrease on a month-over-month basis by 0.1% from November to December 2022 and on a year-over-year basis by 2.8% from November 2022 to November 2023. In November, year-over-year home price rise dropped to 8.6%, the lowest pace in 2 years, ending a 21-month run of double-digit growth. Even as 16 states defied the national trend and had double-digit price increases, many of the nation's most attractive home markets are slowing appreciation. The southeastern states had the highest price increases but also the greatest cooling. In conclusion, there are several warning signs that suggest that the U.S. housing market might be headed toward another crash. While we cannot predict the future, it is important to be aware of these warning signs and take precautions accordingly. If you're thinking about buying a house or investing in real estate, it's essential to do your research and make informed decisions. Thank you for watching, and we'll see you in the next video.